Well, on Friday, January 31st, 2026, Illinois banking regulators walked into a 6-story office building in Chicago's River North neighborhood and seized Metropolitan Capital Bank and Trust. The bank had $261 million in assets. Its deposits were transferred to Detroit-based First Independence Bank. The branch on East Ontario Street reopened the following Monday under a new name, with little fanfare and almost no explanation. But the truth is, this was not just another quiet local bank closure. It was the first FDIC-insured bank failure of 2026. It was also the largest bank failure in Illinois since 2017. And Bezos' review of court records and enforcement filings, published over that weekend, established exactly what brought it down. The bank had long-standing exposure to a commercial real estate loan tied to the largest default in the federal government's skilled nursing facility lending program. Not a securities portfolio problem, not a deposit run, a commercial real estate loan. A loan the bank had been carrying on its books through modification after modification until the day it could no longer pretend the money was coming back. This is the story of 2026. And most Americans do not know what is happening. Every week, across thousands of regional banks spread from Iowa to Florida to the Pacific Northwest, loan officers are looking at their commercial real estate portfolios and doing the same calculation that Metropolitan Capital did again and again for years. Do we extend this loan again and report it as performing? Do we sell it at a loss and realize the hit to capital? Or do we hold it, modify it, dress it up, and hope that interest rates fall, office tenants return, and property values recover before the next maturity date forces our hand? That calculation is the beating heart of the regional purge, and the answer that more and more banks are being forced to give, driven by an accumulation of pressures that have been building since the Federal Reserve began hiking rates in March 2022, is no longer extend. It is sell, charge off, and survive. Let me build this precisely because the word purge requires a specific defense. This is not a dramatic event like a stock market crash. The regional purge is the slow, methodical, largely invisible process by which America's regional banking system is being forced to acknowledge that hundreds of billions of dollars in commercial real estate loans on its books are worth substantially less than the dollar amounts recorded. And the accounting mechanisms that have allowed those losses to remain hidden for 4 years are running out of runway. Start with the maturity wall, because it is the forcing function that converts latent loss into recognized loss. According to S&P Global's commercial real estate debt maturity analysis, $936 billion in United States commercial real estate mortgages are set to mature in 2026, up 18.6% from the 2025 total. The peak is projected at $1.26 trillion in 2027. NMG Real Estate Advisors, in its 2026 CRA refinancing wall analysis, notes that some estimates put total 2026 maturities as high as $1.8 trillion when all modifications, extensions, and rolled over loans are included. That figure is more than triple the 20-year average of annual commercial real estate maturities. And why does this maturity wall keep growing? The answer is brutal. Extend and pretend. The original estimate for 2024 CRA loan maturities was $659 billion. By the time those maturities arrived, the actual figure had ballooned to $929 billion because a massive volume of loans that were supposed to be paid off in 2023 had been modified and extended instead. In 2024, the same dynamic repeated. Cumulative loan modifications nearly doubled to $39.3 billion, with a record $19 billion modified in December 2024 alone. The Timeless Investor, in its January 2026 Substack analysis, described the mechanism with precision. Extend and pretend. 2.0 is the reason the maturity wall gets bigger every year instead of smaller. Every loan that is extended adds to the next year's maturity count, while the underlying property problem remains unsolved. So why do banks extend rather than foreclose? The New York Federal Reserve Bank published the definitive academic analysis of this question in October 2024. Its paper, titled Extend and Pretend in the United States CRA Market, documented this specific mechanism with loan-level data. Banks extending distressed CRA loan maturities were most commonly those with impaired capital positions from their bond portfolios. Exactly the unrealized loss problem documented in the bond market warning script. Banks that are already borderline on their capital ratios cannot afford to crystallize additional CRA losses. Recognizing the full market value decline on a major office loan would reduce the bank's capital, potentially triggering regulatory action or constraining its ability to originate new loans. So they extend, they delay, they pretend. The New York Fed's paper concluded that this extend and pretend strategy was leading to a buildup of financial fragility and credit misallocation, with a 4.8 to 5.3% drop in CRA loan originations since the first quarter of 2022, as banks' balance sheets were consumed by modified loans that could not be recycled into new lending. Now apply the four-stage pattern, because the regional purge follows a historical sequence that has been documented in every major real estate credit cycle. And identifying the specific stage the market is in right now is the difference between understanding this as a structural process and mistaking it for a collection of isolated incidents. Stage 1 is the accumulation phase. This is the period from approximately 2010 through 2021, when regional banks nearly tripled their commercial real estate lending. The Wharton, NYU, and Columbia research paper published in October 2025, titled Too Many to Ignore. Regional banks and CRA risks documented the concentration with loan-level precision. Over the past decade, regional banks have nearly tripled their CRA lending. Today, commercial mortgages dominate regional bank loan portfolios. Collectively, over $1.6 trillion of CRA loans sit on the balance sheets of these institutions. 3 of 4 regional banks report commercial mortgages as their largest loan category. For nearly half, their high CRA concentration exceeds thresholds of potential regulatory concern. This concentration was built during a period of near-zero interest rates, rising property values, strong office demand, and a regulatory environment that encouraged regional banks to compete for commercial real estate business with larger institutions. That was the buildup. That was the quiet loading of the system. Then came stage 2, the shock phase. This began in March 2022, when the Federal Reserve started raising rates at the fastest pace in 4 decades. Rising rates affect commercial real estate through 3 simultaneous channels. First, they raise the cost of new financing, making it harder for property owners to refinance maturing loans at viable debt service coverage ratios. Second, they reduce property values by raising capitalization rates. The inverse relationship between cap rates and property values means that a 200 basis point increase in cap rates on a property generating $1 million in net operating income reduces the property's value from $20 million to approximately $12.5 million, even if the cash flow has not changed. Third, they compress bank net interest margins in the short run by increasing deposit costs faster than loan yields, weakening the bank's ability to absorb credit losses from their CRA portfolios. And Zhuzhang Chu Ila, the Wharton research paper, quantified the first critical measurement, latent distress. That means loans that would be underwater at 2 days' values. And latent distress exceeds contemporaneous delinquency rates by approximately 4 to 1. For every dollar of CRA loan that a regional bank is reporting as delinquent, there are approximately $4 of CRA loans that are technically current, but would show a loss if sold at today's market prices. This 4 to 1 gap between what the books show and what economic reality shows is the hidden iceberg beneath the officially reported delinquency statistics. Stage 3 is the extend and pretend phase. This is the phase that has been running since 2022, and now it is reaching its natural limits. The specific data is documented in escalating detail across multiple official sources. The CRA CLO distress rate, which measures the percentage of collateralized loan obligation products backed by commercial real estate that are in distress, grew from 1.4% in early 2023 to 14.4% by January 2026. That is a tenfold increase in 26 months. George Smith Partners, in its March 2026 analysis, documented that this 14.4% rate is roughly double the peak delinquency levels during the 2008 financial crisis. More than 50% of all CRL loans are past their maturity date. The Real Deal reported in February 2026 that more than half of the estimated $100 billion in securitized commercial mortgages due in 2026 are unlikely to pay off at maturity. The Office CMBS delinquency rate reached an all-time record of 12.34% in January 2026. According to Trey's data published by CRA Daily in February, the previous record was 11.76% in October 2025. The rate had moved from 1.60% in mid-2022 to 12.34% by January 2026, a nearly 800 basis point increase over 42 months. That is not a normal cycle. That is a wall cracking under pressure. Wolf Street's February 3rd, 2026 analysis documented specific examples of the extend and pretend collapse. One Worldwide Plaza, a 49-story office tower at 825 8th Avenue in Manhattan, carries $1.2 billion in debt, consisting of a $940 million senior CMBS loan and a $260 million mezzanine loan. The property was appraised at $1.7 billion in 2017 when the debt was originated and securitized. By late 2025, Trey reported the collateral had been reappraised at $390 million, a 77% haircut from the 2017 appraisal, and far less than the outstanding $1.2 billion in debt. In January 2026, the property had insufficient cash flow to pay the January tax bill or make its December note payment. Extend and pretend did not work. That's Umanoi. This is the moment when the paper fiction meets the actual cash register. Stage 4 is the purge phase. This is the stage we are entering in 2026. The BRG ThinkSet analysis stated it directly. Some banks are quietly dumping real estate loans, indicating that the extend and pretend strategy is losing ground as borrowers face maturity walls they cannot extend through. The Congressional Research Service's September 2024 analysis documented a specific milestone. In mid-2024, a large regional bank sold nearly $2.8 billion in multifamily CRA loans to Bank of America in the largest non-FDIC-assisted CRA loan sale in history. The Congressional Research Service described the sale as strategic and intended to generate liquidity and reduce overall CRA exposure. That single transaction marked the beginning of the market, acknowledging what regional bankers had known for years. The only way through the maturity wall is to sell the problem, not extend it. Now apply the 3 historical case studies that prove this pattern, its trajectory, and its consequences for both the banks carrying the losses and the communities that depend on those banks for credit. Case study 1 is the savings and loan CRA crisis of the 1980s. In the late 1970s and early 1980s, United States savings and loan institutions expanded aggressively into commercial real estate lending, fueled by deregulation that allowed them to move beyond residential mortgages. The combination of overbuilding in commercial properties, rising interest rates, and regional economic downturns created concentrated CR losses in S&L portfolios across the country. The extend and pretend strategy was deployed widely, with regulators actually formalizing the approach under the term forbearance, allowing institutions to carry assets at inflated values rather than forcing recognition of losses that would trigger insolvency proceedings. But thuk tila, forbearance does not erase losses. It only delays the day they have to be named. The forbearance strategy was eventually overwhelmed by the scale of the losses. More than 1,000 savings and loan institutions failed between 1986 and 1995, with the Resolution Trust Corporation ultimately disposing of more than $400 billion in troubled CRA assets at massive discounts. The total cost to taxpayers was approximately $160 billion. The specific lesson from the S&L crisis that applies directly to 2026 is what happened to the communities served by failed institutions. When an S&L failed, its lending capacity was eliminated. Local businesses that had depended on that institution for credit found their lines of credit canceled, their loan renewals denied, and their banking relationships transferred to acquirers who often had no knowledge of or interest in the local market. Commercial real estate values in affected communities declined further as forced asset sales by the Resolution Trust Corporation flooded local markets with distressed properties. The S&L crisis produced a regional economic depression in markets like Texas, Arizona, and New England that lasted years beyond the resolution of the individual failures. Case study 2 is the 2007 to 2009 commercial real estate meltdown. The most directly analogous prior episode to the current cycle began in 2007, when CRA prices began declining from their peak and the commercial mortgage-backed securities market froze. The office CMBBS delinquency rate, which had been below 1% through 2008, rose to approximately 9% by 2010. The scientific paper published in the Journal of Financial Stability in February 2026 stated the finding explicitly. The subsequent bank failures in the Great Recession owed more to pre-crisis exposure to commercial real estate credit than to household mortgages or liquidity risk. More than 250 bank failures between 2008 and 2012 were directly attributable to CRA losses, not the residential mortgage crisis that dominated headlines. But there's a crucial distinction between 2008 and 2026. In 2008, the CRA crisis was driven primarily by construction loans on speculative development, cyclical overbuilding, and a temporary economic recession. When the economy recovered, office demand recovered with it. Properties that had been vacant filled again as employers expanded. Valuations recovered. Many of the loans that looked permanently impaired turned out to be merely delayed. In 2026, the office sector's problem is not cyclical. It is structural. Hybrid work has permanently reduced the amount of office space that the American economy requires. The national office vacancy rate, which stood at approximately 12 to 13% before the pandemic, reached 22.6% in the first quarter of 2025 per JLL, with 1 billion square feet of vacant office space in the United States. Moody's projected in mid-2024 that vacancies would reach 24% by early 2026. Commercial Cafe's April 2026 office market report documents the national average at approximately 17.6 to 17.8%, with Western markets averaging above 19% and Seattle specifically at 25.1%. Cushman & Wakefield's first quarter 2026 United States office market report notes that vacancy has been essentially flat over the past year, rising just 5 basis points since the first quarter of 2025, and Class A vacancy is down 30 basis points year over year. But this apparent stabilization masks the permanent impairment in the older, lower quality office stock that constitutes most of the collateral behind the bank loans showing distress. The flight to quality dynamic documented in Wolf Street's Analysts means that newer Class A buildings maintain better occupancy, while older Class B and Class C buildings experience accelerating vacancy as their tenants upgrade to better space upon lease expiration. Older buildings cannot fill their vacancy because the tenants who leave them for better space never return. The building that was appraised at $1.7 billion in 2017, based on occupancy by firms that no longer need that space, is now worth $390 million. That value destruction is permanent in a way that the 2008 CRA cycle's value destruction was not. Case study 3 is the New York Community Bank warning in January 2024. On January 31st, 2024, New York Community Bank Corp reported a surprise quarterly loss, slashed its dividend by 70%, and disclosed that it had set aside $552 million in provisions for loan losses. The bank's stock fell 63% in 3 days. The cause was commercial real estate, specifically multifamily loans in New York City, where rent control regulations had capped rental income increases while operating costs rose. NYCB's announcement triggered a sector-wide sell-off in regional bank stocks as investors recalculated the CRA exposure embedded across hundreds of institutions that had not yet disclosed similar problems. What makes the NYCB case the most instructive template for what is happening in 2026 is its demonstration of how an officially reported delinquency rate of 1 to 2% can coexist with a latent distress rate 4 times higher. NYCB's CRA portfolio had been showing manageable delinquency metrics for years before the shock disclosure. The bank had been extending, modifying, and reclassifying loans to maintain the appearance of portfolio health. When regulators required a more conservative assessment of the loan book's actual condition, the gap between the reported metrics and the economic reality became visible in a single quarter. The 4-to-1 ratio between latent distress and reported delinquencies that the Wharton research documented is not a future theoretical risk. It is the observed relationship in actual bank loan data. NYCB demonstrated exactly what happens when the gap between latent distress and reported delinquency closes. Now, apply all 3 case studies to the specific current environment in 2026. The Doge factor is the newest accelerant in the regional purge, and it is the one financial markets have most substantially underweighted. The federal government is the largest single tenant of commercial office space in the United States, with the General Services Administration managing approximately 149 million square feet of leased space across more than 8,400 buildings in more than 2,200 communities. Doge's lease terminations, documented through April 15, 2025, at 7.56 million square feet across 653 leases per JLL's Federal Lease Termination Tracker, represent the beginning of what the General Services Administration projects could be up to 78 million square feet of terminations by the end of 2028, as leases expire or termination options are exercised. Barclays estimated in early 2025 that approximately $12 billion in commercial mortgage-backed securities loans were tied to government-leased buildings. Yale's Layoint and Choice study, published in August 2025, documented that Doge's lease cancellations drove up the cost of CMBS as investors priced in more risk and estimated that the actions could erase up to $575 million in value from the DC commercial office market alone over 5 years. Properties that were valued on the basis of federal government tenancy, the most creditworthy possible tenant with average lease terms of 14 years, are now being revalued without that anchor tenant. And that creates immediate collateral impairment on loans that banks were carrying at face value. But thuktala, the real danger is not one lease. It is the compounding dynamic. Regional banks hold CRA loans. Those loans are secured by properties whose values are declining because of vacancy. The vacancy is being accelerated by Doge lease terminations, by the structural shift to hybrid work, and by the flight to quality that concentrates demand in a narrow tier of premium space. The banks cannot extend their way through this problem indefinitely because the maturity wall creates forcing events. When a loan matures, the bank must decide whether to refinance, which requires the property to generate enough income to service new debt at current rates, or to declare the loan non-performing and begin loss recognition. Properties that were appraised at $500 million in 2018, when they were fully occupied with federal tenants, now standing 30% vacant after Doge lease terminations, cannot support new financing at anything close to the outstanding loan balance. Here are 3 false narratives about the regional purge that are preventing most investors and depositors from understanding the scale of what is happening. The first false narrative is that the official delinquency rate, which per FDIC fourth quarter 2025 data sits below 2% for bank-held CRA loans, represents the true level of stress in these portfolios. The Wharton research established directly and with loan-level data that latent distress is approximately 4 times the reported delinquency rate. A 1.5% reported delinquency on $1.6 trillion in regional bank CRA loans represents $24 billion, 4 times that is $96 billion in loans that would be classified as underwater if marked to current market values. That is $96 billion in losses sitting on regional bank balance sheets that are not reflected in any quarterly earnings report, any FDIC quarterly banking profile, or any credit rating report. They exist. They are real. They are simply deferred. The second false narrative is that the extend and pretend strategy can continue indefinitely, buying time for conditions to normalize. The New York Fed's paper was explicit about the limits of this strategy. It documented that maturity extensions have fueled the number of CRA mortgages set to mature in the near future, creating a risk of a large number of losses materializing in a short period of time. The December 5th, 2025, rescission by the FDIC and OCC of the 2013 Interagency Guidance on Leveraged Lending, documented by George Smith Partners, removed one of the last formal constraints on leverage. But that regulatory loosening cannot reduce the fundamental problem. The properties backing these loans are generating less income than required to service the debt that was originated when they generated more income at lower interest rates. The third false narrative is that because the largest banks, JP Morgan, Bank of America, and Wells Fargo, are not showing dramatic CRA stress, the sector is contained. The Wharton research established that the largest total direct CR exposure falls on regional banks. The financial content analysis from October 2025 documented that regional banks carry approximately 44% of their total loans in CRA, compared to 13% for larger banks. The S&P Global Analysis from November 2025 projected that provisions for loan losses at regional banks could rise to 24% of net revenue in 2026, up from 20.8% in 2025. S&P had already downgraded outlooks on 9 United States banks, representing 18% of the institutions it rates, with most downgrades explicitly tied to CRA exposures. The specific institutions flagged included First Commonwealth Financial, M&T Bank, Synovus Financial, Trustmark, and Valley National Bank. Here is what the regional purge means for every American who lives in a community served by a regional bank. Regional and community banks represent approximately 30% of all commercial banking assets in the United States, but the majority of small business lending in rural and suburban markets. The FDIC's community banking data documents that community banks make the majority of agricultural loans, the majority of small business loans in counties with populations under 5,000, and the majority of construction and development loans in smaller metropolitan areas. These are not Wall Street institutions. They are the financial infrastructure of American Main Street. When a regional bank is forced to recognize CRA losses, its capital position weakens. Weakened capital constrains new lending capacity. A bank that loses $50 million in CRA charge-offs must, under standard capital requirements, reduce its total loan book by approximately $500 million to maintain its capital ratios, or raise new equity capital, which is expensive and difficult for smaller institutions. That $500 million reduction in lending capacity translates directly into small businesses that cannot access operating lines of credit, farmers who cannot finance planting seasons, and commercial developers who cannot find construction financing for projects that would create local employment. The Safer Banking Research Analysis from March 2025 quantified the specific population at risk. If a 3.3% non-performing loan ratio materializes for CRA loans, which would still be below the 9% delinquency rate reached during the 2008 crisis, banks with CRA exposures greater than 300% of equity capital would face major capital impairment. There are nearly 2,000 banks in that category. That number is not a doomsday projection from a fringe analyst. It is a mechanical calculation from FDIC regulatory data applied to the same 4-to-1 latent distress multiplier that the Wharton research documented. The Iran war has added a specific and underappreciated accelerant to the regional purge dynamic. The financial content March 2nd, 2026 analysis of the KRE Regional Bank ETF, which plunged 5% when Operation Epic Fury began, captured the mechanism precisely. Regional banks face what it called a double whammy. If the Federal Reserve is forced to keep interest rates higher for longer to combat Iran war inflation, the higher rates prevent CRA property owners from refinancing maturing loans. That means more loans go past maturity. That means more extend and pretend decisions. That means more latent distress accumulation. Simultaneously, higher rates increase the bank's cost of deposit funding, compressing net interest margins and reducing the earnings cushion the bank has to absorb future credit losses. The same force that makes the CRA problem harder to refinance also makes the bank's financial position less able to absorb the resulting losses. The double whammy converges on exactly the population the FDIC is monitoring most closely. The FDIC fourth quarter 2025 report documented that the banking industry continued to navigate weakness in certain portfolios and elevated unrealized losses, among other challenges. The first quarter 2026 FDIC data, which will capture the full Iran war period's impact on both unrealized bond losses and CR delinquency trends, has not yet been released. When it is released in late May 2026, it will provide the first comprehensive official measurement of how the converging forces of the maturity wall, the Iran war's higher for longer rate impact, the Doge e-lease termination accelerant, and the structural shift in office demand have combined to move CRA stress from the latent distress stage toward the recognized loss stage. Here is the specific number that nobody in the financial press is putting into a single sentence. $1.6 trillion in CRA loans on regional bank balance sheets, 4 times the reported delinquency rate in latent distress, per Wharton's loan level research, a $936 billion maturity wall in 2026 alone. An office CMBS delinquency rate at 12.34%, the highest ever recorded, higher than the 2008 financial crisis peak. A CLO distress rate of 14.4%, 10 times higher in 26 months, double the 2008 crisis peak. The first bank failure of 2026 tied to commercial real estate, nearly 2,000 banks with CRA exposures above 300% of equity capital, and the Fed forced to keep rates higher for longer by the very energy shock that makes refinancing those loans more expensive for the borrowers who hold them. The regional purge is not a prediction. It is a process that is currently underway, visible in loan modification data, visible in CNBS delinquency reports, visible in bank provisioning disclosures, and visible in the weekly FDIC bank failure list that, in February 2026, recorded its first 2026 entry. The question is not whether losses will be recognized. Losses are being recognized every quarter through charge-offs that Bizo described as banks purging bad CRA debt from the good old days. They are being recognized through quiet loan sales that the Congressional Research Service documented as the largest non-FDIC-assisted CR loan sale in history. The real question is whether the recognition happens at a pace that allows the banking system to absorb it in an orderly way, or whether a triggering event, a major borrower default, a sharp yield spike from the Iran war, or a Doge-driven office market deterioration in a concentrated region accelerates the recognition into a period that overwhelms individual institutions' capacity to absorb the losses. The purge is quiet. It happens in loan modification documents. It happens in quarterly provision line items. It happens in Friday afternoon FDIC seizure announcements that generate 3 sentences in the local paper. But Ju Zhang Shui La, it is happening. And the maturity wall does not care how quietly it happens. If you find this analysis useful, leave a comment with your view, like the video, subscribe for more, and tell us what you think we should examine next.